Ever wonder where the next Apple or Nvidia comes from? Forget the stock market frenzy. The real growth often happens before companies even go public, and that's the world of private equity. Did you know that private equity has outperformed the public markets over the past 23 years? This chart from the CAIA Association shows the performance of private equity versus public stock markets from 2000 to 2023. It's really pretty astounding. Private equity allocations by state pensions produce an 11% annualized return after fees over that period. That's substantially higher than the 6.2% annualized return by investing in public stocks. Maybe that's why university endowments and foundations have been increasing their allocations to private equity over the past 20 years. But hold on, private equity is exclusive to the ultra wealthy, right? Well, for decades, the best private equity managers, which is who you want to invest with, had seven-figure minimums, and often you needed to have a personal relationship with them in order to get access. But that is beginning to change. Just like there are companies breaking down barriers to investing in real estate, art, and fine wines, there are few companies doing incredible things to bring access to private equity for as little as $10,000. You heard that right. I wanted to learn more about what is happening in private equity and the incredible blockchain innovations that are breaking down investment barriers, so I interviewed Jamie Finn, the president and co-founder of Securitize. Now, in full disclosure, Securitize is a sponsor of my video series on alternative investment strategies, and this video in particular. This is not an endorsement of Securitize. Investors should perform their own due diligence before investing in any alternative strategy. All right, let's chat with Jamie and learn why private equity may be worthy of a place in your investment portfolio and how you can get started even if you aren't a Wall Street insider. Jamie, so glad to have you in this video to help us better understand private equity and accessing private markets.
Thanks, Colin. Really happy to be here. Excited to be able to talk about this. It's an important topic for me, both personally and professionally.
For sure. Why don't you first tell us a little bit about your background and how you got into private market investing?
Yeah, absolutely. Throughout my career, 20 plus years working in tech and telecom, I've had a lot of opportunities to invest in a variety of different types of vehicles, and mainly had invested through public markets into different financial instruments. But in 2017, I had moved to San Francisco and was living there full time. And as most people know, San Francisco is kind of the hub of all things tech, and so as a part of that, there's a big venture capital community. And so as an investor, kind of looking at potential places to put money, all I was hearing about was these people who were just making unbelievable returns
sure.
by investing in these venture capital funds. And I thought, that sounds amazing. And so I did what most people do, and I went on the internet and was like, hey, I'd like to invest in this area of venture capital. What's available? And again, this is 2017, right? So it's not exactly the apex moment in being able to access a whole bunch of alts. And I couldn't find anything. And so conveniently, one of my ex-colleagues from a telco that I worked at reached out and said, well, I have great news. I'm creating a new way for people to be able to invest in venture capital and a variety of different alts. Would you be interested in investing? And being, kind of interested in this space, I said, yeah, I'd absolutely be interested in investing potentially. And so he said, great. And he presented a venture capital fund, which was designed essentially to allow for a lot more investors to be able to enter the fund and for them to be able to also exit the fund, which is a really important thing for me because, I might need the money at some point. One of the scary things about venture is a 10-year lockup. And so when he presented this, I instantly made sense to me and I loved it. And I put a whole bunch of money into it, of my own personal money. And really that's how I got kind of interested in the space, was this nature of having this big community around me making all this money and me wanting to participate, but really being locked out of that space until the person who brought this to me is now my co-founder at the firm, brought this whole new idea which I was just super excited about.
That's great. And I think a lot of people probably feel very similarly. They've heard about the asset class. They've heard about the returns people are making and are wondering how they get access to it. I get questions as a financial advisor about it all the time. Before we get into the nuts and bolts of things, let's take a step back. And for people that are new to the area, what are private markets and how are they different from, say, investing in the S&P 500?
Private markets are kind of a mystery, but they're also not, right? So if you think about the public market space, that's where most people are kind of investing their capital, and they can go on a Robinhood or a Schwab and go and buy shares in, AT&T or GE or whatever type of firm they want. And these companies, are available to anybody who has an account, and essentially are liquid, meaning you can buy and sell them very easily via an exchange. And the public market is actually quite small in comparison to the private market. And private markets have been growing over the past decade. About 90% of companies who have over $100 million in revenue are privately held. So there is a huge group of companies in the U.S. that you really don't have access to. And so,
wait, I've never heard that. That's an incredible stat. Can you say that one more time?
Yeah, absolutely. 90% of companies with revenue over $100 million in the U.S. are actually privately held.
So that's a huge market for people to invest in.
It's a very, very significant market and a huge opportunity.
All right, well, that explains private markets in general for sure. But let's talk about why people generally want to invest in private markets.
So generally speaking, private markets have a couple of pretty significant benefits. They have, in terms of absolute returns, they've exceeded public market returns over the last 20 years. Historically been a better place to put your money as opposed to the public market. And one of the other nice things about private markets, when you access them through a fund type structure instead of trying to pick individual companies as winners, is you have the benefit of diversification. And so you have highly experienced investment professionals putting together a curated portfolio of the best companies in the space. And those funds that are out there today have historically returned, significantly better than the public markets. In fact, it's almost 2 times better than the public markets.
Yeah, I mean, that's pretty incredible, and obviously a good reason to invest in the private markets for sure. And that's why people have been more and more and more trying to get access to this stuff. So, I mean, I want to bring this back to that stat that you brought up of 90% of companies that have revenue over $100 million are privately held. Are those investment opportunities just exclusively available to private equity firms, or could I just go out and do that?
You could potentially go out and find individual firms to invest into. It's generally not advisable to go out and make your own investment decisions. It's more, and it is historically just better to be able to diversify your investment by accessing, a private equity fund or a hedge fund or a venture fund. Now, there are a number of challenges accessing those types of funds. One of them is that normally they have very high minimum investments, and additionally, they have what's known as illiquidity, which means you can't sell the position. So if you need the money, your money's tied up. And so these are 2 big roadblocks for folks to be able to invest in private equity. And also, you have to know the right people. That's one of the hardest things about, and it's actually one of the things I never really understood. It's like, I have money. I want to invest money in this fund. Take my money. And the answer you get is no, we're not taking your money. We're taking somebody else's money because we don't know you.
And you hear that a lot because if you're watching CNBC or CNN or Fox News, whatever you watch, you hear about private equity and you hear the big names, the Blackstones, the KKRs, the Apollos, the Carlyles, and getting access to those funds. And typically, if you're going to get access to those funds, like you said, you need to know somebody in order to get in there because they're often just not accepting money into their premier funds. And so then you might be going down to second tier or third tier funds. So it's a really interesting space for sure. And what I really want to know about is why is it that the private markets generally perform so well and so much better than the public markets?
Yeah, it's a great question, and it's one we get very often. And I think it really comes down to a couple of key aspects. One, these are by far the largest sources of capital for individual companies for them to be able to raise money. So if you have the best company in the world and you need a big check, you're going to go to one of these humongous investors. Those investors have better data on all of the companies in their portfolio, and they have so much detail it would blow your mind. As smart as I think I am, there's no way I would be able to pick a winner in comparison to one of these large asset managers like a BlackRock or a Hamilton Lane or a KKR. So I think that is really the biggest advantage they have is data.
All right, so to further illustrate that performance, we've got this information from CAIA on long-term private equity performance from 2000 to 2021. If you could just kind of walk us through this chart a little bit, that'd be great.
Yeah, sure. So what you're looking at here is sort of an aggregate data of performance across these two large categories. And what you see is a diversion really starting in 2004, apologies, where private equity really starts to return kind of outsized returns. And if you think about what's happened over this time period between 2004 and 2021, we really had two significant sort of financial implosions, or what were perceived to be implosions. We had 2008, where you had a huge, I personally got smoked on that one. And I remember looking at my bank account and wondering what was real. And then again, you had what was thought to be a real disaster with COVID, which didn't end up being it. And so what you're seeing in terms of this diversion is really patience. And so patience is one of the really interesting things about private equity. Private equity has more time to deliver a return than public markets can because they are less liquid, meaning you can't buy and sell private company shares instantly. They drive a certain behavior, and that behavior is to have more patience and to reinvest in order to get more growth out of the firm. So because these large private equity shops have huge amounts of dry powder, they can essentially weather the storm, reinvest in their winners, and then that's when you get this outsized performance. It's really an unfair advantage that they have versus public stocks. And so I always look at it like, why can't I take advantage of it? And here it is, in proof.
So that makes a heck of a lot of sense to me. And when you look at that staggering outperformance, which is kind of incredible to see, it makes me think about, going back to that due diligence, the types of companies that they're looking for to invest in. Are they looking for companies that are, like Amazon before it was Amazon and Netflix before it was Netflix? Or are they looking for turnaround stories of companies that are just run really poorly and they can come in and change them? What types of companies do they go after?
It's a great question, Colin. And the answer is all of the above. It just depends on the type of product that you're buying.
We've been talking a lot about the positives of being in this space. And a lot of what I try to do for my clients is help them answer the question, what am I missing? What are the risks out there that I'm not thinking about? So as we think about the private markets, what are the risks when you make investments in that space?
The risks also drive the return. So it's a great question, right? So, I think one of the biggest risks is illiquidity, right? So in the private market, when you buy something, there is no guarantee that you can exit that position at any specific moment in time. Or private vehicles tend to have 7 to 10, even 14-year lifespans, which means over that window, you're not getting all of your money back, and you can't decide when you get your money back. They decide when they pay it out based on the exit of one of their investments. Additionally, the performance of the fund really depends on the exit strategy and how they're able to kind of exit the investments they've made. And this is actually the third point is probably the most important one. The biggest risk is buying not the best products. So if you look at private equity, the top quartile, the top 25%, outperform everybody else by multiples. And so if you're not buying one of the name brands and you're buying some unknown asset manager, then you are taking on a lot of unnecessary risk. And that risk will impact your return and it will impact your exit because they simply don't have the ability to negotiate the types of deals the larger top end shops are able to do. You want to be in the top 25% if you're going to be investing in the space. Otherwise, it's really not worth the risk.
Well, that makes sense to me, and I've heard a lot about that. There's a lot of people in the private equity space, and it's like any other investment manager or probably any other business where you have people that are really good at what they do, people that are okay at what they do, and people that are poor at what they do. And in this space especially, you've got to focus on the top quartile people, just like you talked about, who've got the experience, have the track record, have been in the space to do this. One of the other things that people will ask me about because they hear it is the high fees associated with investing in private markets, the 2 and 20. The most of the money goes to the people running the fund, and we get the leftovers. Can you talk a little bit about the costs involved in traditional private equity?
Yeah, absolutely. So let me explain a little bit. So the 2 and 20 refer to the fees that the funds charge to manage your money. The 2% is the amount that the fund charges based on the total amount of capital invested in the fund. So if you have a $100 million fund, they're going to take 2% of that to manage the fund, and that's on an annual basis. So that's the 2%. And then the 20% refers to the carry. So if they have an exit and they sell a company that they bought for $1 million for $100 million, they're going to take 20% of those profits right off the top and put it in their pocket as part of the fund. And then they distribute 80%. Now, you might be thinking, hey, I should get 100% of it. But the reality is you have to pay for their time and investment. And so that is really the 2 and 20. 2 and 20 has been the historical rate. There are a variety of different vehicles that exist today. And you'll see kind of more established managers will bring the price down based on the share class. And so one of the things that happens here is there's this concept of a share class of different types of shares for different types of investors. So this is another area to look out for. And you really want to be able to access an institutional share class, not a wealth management or a retail share class, because those will have additional fees on them. And then the other thing to look out for is what types of fees you are paying, to your wealth manager and how those accrue on top of that standard. Understanding those costs either as a self-directed investor making your own investments or working through an investment advisor is important.
A lot of the clients that I work with, the number one thing on their mind is protecting their capital and keeping it away from the government. Of course, in all ways that we should be doing things, but tax planning is really important for building wealth. Can you talk a little bit to me and to our viewers here about tax planning as it relates to the private markets?
Yeah, absolutely. It's a great question. Because these are private markets, because they are liquid, and you are generally what's known as a limited partner in these funds, you benefit and have to deal with some of the intricacies of the way that these products are structured from a tax point of view. And so one of the things that most people don't realize is that these don't issue 1099s as you might expect. Instead, you're going to get what's known as a K1. K1 is a whole different experience, and they don't necessarily come at the same cadence as your normal tax forms will come. So they may come, 3 months after April 15th, and you have to kind of file an amendment on your taxes. It's an important thing. But you also get the losses and profits of the fund. So normally a fund experiences what's known as a J curve. The J curve is during the first 3 years of the fund, it tends to go down a little bit, and then the fund tends to come back and deliver an outsized return. The reason for that is a lot of the costs, and you're investing in new companies. As soon as you put the money in, it's not a profitable venture. It takes a couple of years to see the return. So, but what happens is with the K1 structure, during those first years, you're able to kind of get the benefits from that, from those losses, and kind of harvest them. And then in the future years, obviously, you're going to have the returns, which you have to pay the taxes on. There's no way to get away from that. But you do at least get the benefit in the early years of it. So it's just an important thing to understand how taxes work on these funds. And there are, I should say, different types of funds. Some funds are, traditional private equity looks like that with a K1. Some funds are accumulation funds. This is a fund where instead of paying out a distribution, the share price continues to increase until you decide to exit. And when you exit, then you would be dealing with either long-term or short-term capital gains, depending on how long you've held the asset. So understanding tax structures and how these things are put together is really important. But you should also know that these asset managers hire the smartest and best people in the tax industry to structure their products and create the most efficient ways that they can help their limited partners receive the benefits and reap the rewards, if you will, of the asset. Where's the best place you could possibly put some money that you can't access for a couple of decades?
In a retirement account, I'm guessing?
Yeah, in a retirement account that is investing in private equity funds. Because, yes, you have the tax deferrals, but since you're not, this is an illiquid asset, right? Like we talked about at the beginning. And so the ability to invest your IRA into these alternative funds, which we've shown already have significantly better investment than public markets, is a perfect match, really.
I like it. And, you know, a lot of us are trying to build retirement accounts, right? And so matching growth-oriented strategies with retirement accounts for later on down the line makes a heck of a lot of sense. There's a lot of innovation that's going on in the alternative markets in general. And I would love it if you could talk a little bit about how the industry and how you guys specifically at Securitize are making more accessible the private markets.
Yeah, so, you know, as I mentioned at the beginning, I really got involved in this business to solve my own problem, which was how do I invest in some of the best performing assets that I had no access to. And kind of what I've learned over that time is that these asset managers actually want you to invest in their products. They just have no idea how to let you in the door. And so that's really where we come in. Our firm has specialized in helping self-directed investors and investors who just don't have multi-million-dollar checks access the world of private equity. We've done this by digitizing the entire experience. We've added a new component, and that new component is this idea of tokenization. And you might be wondering what tokenization is. The token itself provides proof that you own it, so the provenance, and it allows you to take advantage of some pretty cool new features which address some of the biggest gaps, in my opinion, in the whole world of private equity investment. And to me, it's really get back to it, you know, it's all about liquidity and illiquidity, right? So as we talked about, illiquidity is what provides the outsized return along with the information. But what's really interesting here is our platform allows you to get liquidity on your shares or on your investment, I should say, whenever you want, assuming there's somebody else that's going to buy the other side of the trade. So we're enabling people to buy and sell their position, which reduces the kind of risk and fear, I think, of holding something for a decade, while still providing you with the outsized returns if you hold all the way through the fund life.
So you're providing enhanced liquidity that didn't exist before through a platform that you can invest online without all of the back and forth and paperwork and things like that of a traditional investment. Like, this sounds appealing to a lot of people because that was kind of an impediment to a lot of things that were going on. One of the reasons why you invest in private equity is because of that illiquidity premium. And so now you're just talking about how you're starting to remove that by allowing access. How is that going to affect the returns on private equity now that tokenization is starting?
So it's a great question. And it's sort of, you have to understand kind of two pieces. One is your investment and your money that goes into the fund. So when you put your money into the fund, you're not able to withdraw your money from that fund unless they offer a redemption or something like that. Now, what you can do is you could sell your investment to somebody else. And that person is now buying that investment from you. Your money is still in the fund invested, and now the other person owns what's known as that limited partner position because they've acquired it from you. And so the fund doesn't actually have any money withdrawn from it. So you still benefit from the liquidity premium while still being able to access liquidity by being able to sell it to another person. And so that's how those two pieces.
This is great because that is one of the things that I think people understand, that when you invest in businesses, you're investing for the long term. But a lot of people, life happens, people need money, and things are locked up and you don't have access to it. You want to be able to get access to your money. This really is changing the game and how this investing in this area is taking place. So tell me a little bit more about Securitize and the role that you guys are playing in that private space.
So Securitize essentially works with the asset managers to create tokenized versions of their products so that more people can invest in these private equity, private credit, and venture funds and hedge funds. So essentially, we're the kind of the bridge between the two. They have they're experts in their funds. We're experts in onboarding investors in a really easy and digital way, and then helping them kind of manage their shares in a very frictionless way. So we are essentially the entity that receives the capital, manages the investment with the fund, and is the main interface to the fund. And then you as an investor interface with us, providing kind of all the reporting, information, distributions, all that kind of stuff. And, we are in the US a heavily regulated entity. We're a broker dealer like a JP Morgan or Goldman Sachs. We're also a transfer agent, which means we manage a cap table, another regulated entity here in the US. And so everything is done, according to the standards that every broker dealer and transfer agent has to operate in, which are regulated by the SEC and FINRA, which are the two main regulatory bodies in the US.
So that's exciting to me also, because I love working with small business owners. I see businesses growing over time, see the investment opportunities that are there, and now thinking about how you can invest in it in an IRA a lot easier or in a taxable account. Could I just take $100 and put it into one of these funds, or is there any minimum to this stuff? I mean, it used to be $5 million, $1 million to get into different products.
So we do actually have some products that you can invest in for as little as $1,000, but that's more of a money market fund type of product. If you really want to get into private equity or private credit, you're going to be looking at about a $10,000 minimum or $20,000 minimum for some of the funds. And a number of the products are actually exclusive to Securitize. For example, KKR's Healthcare Growth Fund 2 is exclusive to our platform. Hamilton Lane's Equity Opportunity Fund 5 is also exclusively available on our platform. So it's a great opportunity to access some amazing funds that we offer through the platform.
So if people who are watching this are interested in learning more about Securitize and the private markets and what you guys are involved in, where should they go?
Well, the best place to go is our website. It's securitize.io. And you can also go to the App Store and look up Securitize Alternative Investments. And you'll be able to download our app on iOS or visit it from a web page.
And Jamie, thank you for taking some time to come on and explain this world of private equity and private credit in more detail for people. Let people know about tokenization, what's happening in the space, because it has been a really opaque area for a long time, and people have wanted access to it for various reasons. For my clients, for people that we're looking for, is diversification purposes, having something that's not tied to the public markets, that's being marked every single day. That can be attractive in both up markets and in down markets. So what you're doing is great. Keep up the good work. And stay in touch for sure.
Thanks so much, Colin. Appreciate it.
And now watch this video on another alternative investment strategy.